Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll be discussing one question of profit reconciliation statement where we are coming across notional expenses. Now what is notional expenses? Notional expenses means those expenses which are not actually paid. As they are not paid, they are not recorded in financial book. But for calculating correct cost of the product, even though those expenses are not incurred, we are required to record them in cost book on the basis of standard expense. Let us read the question. From the following information, find out profit or loss as per financial account. Loss as per cost record 12,900. So here we are having loss as per cost book. Under recovery of depreciation in cost account. That means in financial book depreciation is taken more and in cost book it is less, under recovered by rupees 4,900. Notional salary of proprietor not considered in financial profit and loss account. So your item is notional salary which is not actually incurred but it is recorded in cost book. Overvaluation of closing stock in financial account. Over absorption of factory overheads. We are required to prepare working notes. In working note, first column is particulars. These are the two amount columns. Our profit reconciliation statement will start with cost book because in question they have given us loss as per cost book. So that will be the first item. First column cost book amount column. Second will be amount column for financial book. Third column is difference in amounts. Either that has to be added or subtracted in profit reconciliation statement. So this last column helps us to understand whether a particular item we are required to add or we are required to subtract while preparing profit reconciliation statement. Under recovery of depreciation in cost account 4,900. So this depreciation is recorded in financial book, but it is not recorded in cost book. So we'll put that value in financial book column. It means whatever depreciation is recorded in cost book, depreciation as per financial book is more, 4,900. Notional salary of proprietor 12,000. This is an expense, it will be recorded only in cost book. Overvaluation of closing stock in financial book 1200. Closing stock have effect of income. So overvaluation of closing stock in financial book income will be recorded only in financial book 1,200. Over absorption of factory overhead 7,000. This is an expense which is taken more in cost book. So we'll put 7,000 in cost book column. It indicates that whatever expense is shown in financial book, cost book is showing factory overheads more by 7,000. So we have recorded all the information. Now from first column, we are required to deduct the values of the second column. So in case of depreciation, in first column there is nothing. So 0 minus 4,900, it will be minus 4,900. Notional salary of proprietor 12,000 in cost book minus 0. So here it will be plus 12,000. Over absorption of factory overhead 7,000 minus 0 plus 7,000. Over valuation of closing stock 0 minus 1200, it should be minus 1200, but as it is an income, we are required to reverse the sign, so we have to take plus instead of minus. This rule is applicable only for income. In case of expenses, we have to take actual signs. Loss as per cost records 12,900. This will be starting point. It will be recorded in outer column. As it is a loss, we are putting this in bracket. To this we are required to add 1, 2 and 3 items. Notional salary of proprietor 12,000. Over absorption of factory overheads 7,000. Overvaluation of closing stock in financial book 1,200. Under recovery of depreciation in cost account 4,900. We have added these positive numbers 20,200, loss 12,900 is deducted, we got 7,300. To this we have deducted 4,900, finally we got value 2,400. This is a positive number, that means there is profit as per financial book 2,400. So we have started with loss as per cost book, and finally we have arrived at profit as per financial book. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.